Welcome to the Multifamily and More Expert Series. This is a series where we get guests on that dive into one specific topic in the area of real estate, mindset, or anywhere in between. My name is Jamie Gruber, and I'm proud to welcome our guest today, Phil Capron. Phil is you name it, a veteran, which I applaud you for, a skydiver, a former poker player, a soon-to-be author, and of course, a big-time real estate investor. So Phil, welcome to the Expert Series.
Don't bluff the poor people telling them I'm a big time, Jamie.
You're pretty big time. Why don't we get a little
intro, brother?
Why don't we get a little bit of insight into how big time you are? So give us a little bit about what you do and what your investment portfolio looks like.
I guess it's all relative. I was just trying to make a poker joke. So current portfolio, about 244 units, or not about, exactly 244 units in my portfolio. Own them all as small joint venture deals, and I'm working on some larger deals. A couple of partners and I are launching a fund. So working on playing in more like the traditional syndication space, but how I moved away from the single family and like the flipping side of the house into multifamily was with small partnerships. So I'll always have kind of an affinity for that structure.
Makes sense. All right. So Phil has done enough deals and he analyzes enough properties that I thought I'd bring him on to talk about something that, can be elementary, and we'll start with the basics, but then get a little bit more advanced. And that is the core concept of cap rates or capitalization rates. These are very central to anything you do in the commercial space. In fact, if you simply understand the basics of this and you're just starting to enter the multifamily space, then instantly you can have credible conversations. That's been my take on it anyway. So there's more to it than just cap rates, but it's a big piece. So Phil, why don't we just start kind of simply, what is a cap rate or what is a capitalization rate?
Great. So what a capitalization rate is in investor speak is it's a way that we can speak uniformly as a way of quantifying risk. So if you're saying, hey, we're looking at this multifamily deal, it's in kind of a rough neighborhood, and we think we're going to get it at a 10 cap. In today's market climate, that would indicate that the deal probably a little rough, right? So the cap rate is a function of your risk that you're taking on when you're doing a deal like that. Or let's say we'd compare it with like an office space in like a downtown core market that's trading at a 4 cap. That would mean, hey, look, we've got, A+ tenants in here, 10-year leases. It's going to print money. So that's, if we're comparing cap rates, higher means more risk, lower means allegedly lower risk. And then inversely, a higher cap rate is going to be, a lower valuation, a lower multiple, so to speak. And a lower cap rate is actually a higher valuation. So it takes sometimes a few examples to go over. There's a lot of resources online. You can just look up, what's a cap rate.
Yeah.
And they'll take you through a few examples that you can kind of wrap your head around that. So low cap rate means that you are in a hot market or you've got an asset that is deemed relatively safe by the pool of eligible investors out there. High cap rate, you're purchasing at a high cap rate, there's probably something a little wonky about it. Could be the area, it could be a lot of deferred maintenance, could be bad management. On some level, you are taking on more risk is the theory behind a cap rate.
That makes sense. I'm sorry?
Did I go too far into that?
No, I think it's just like a stock. When you think about it, like people understand that a little bit better, I think. So the cap rate itself, like when you say a 4 cap or a 10 cap, that's the percentage of return that you would expect to get if you were to pay for a property cash, right? So if I were to buy $1 million property and I get a 10 cap on that, or it's trading at a 10 cap, that means I would expect to get a $100,000 return if all goes well. If it's a 4 cap on that $1 million property, I would get a $40,000 return. And if you think about it in stock terms, like that's not guaranteed. Just like a stock isn't guaranteed to return you anything. But if you were to buy a sort of like a small cap, up and coming company that's not established, right? you may be buying that with the idea that, man, this could go up 50%, right? So there's more risk in that. So you buy, that the price is lower as a result. Whereas you go Procter and Gamble or Microsoft, these Amazon, well, maybe Amazon's a bad example, but these big companies that are established, like, when you put your money in there, there's a better chance you're going to get a return, but that return is going to be safer, 3, 4, 5%. I think that's a fair comparison, wouldn't you say?
Yeah, absolutely. That's perfect. That's perfect. Different asset class, but we're trying to express, risk, trying to quantify risk. And then we can also use a cap rate. There's a lot of assets out there, maybe people have noticed, that are listed unpriced. Have you seen that?
I have, yeah.
So if we know what the net operating income is for a property, so that's gross revenue minus expenses that are above the line, and that's probably a different conversation. So let's just call it expenses, total income minus expenses equals net operating income for our purposes.
Not including debt, just to be clear.
Exactly.
Expenses.
So yeah, I wasn't going to go with the whole below the line, above the line thing.
Yep.
So what's called above the line expenses are true expenses, things like your utilities, your taxes, your insurance. Let's see. Repair and maintenance is where it gets weird, because some of that you can call a capital expenditure, which technically is below the line, below
property management. You said utilities, water bills, those sorts of things for sure. Yep.
Vacancy, bad debt, all that stuff.
Yep.
So anyway, we arrive at our net operating income. So if we can take our net operating income, if we have that, we can go and say, Mr. and Miss Broker, what do you think this deal is going to trade at? For pricing guidance, they might not give you a dollar amount for what the seller is looking for, but if they say, hey, we're in a good market here, the NOI is 100,000 and we expect it to trade at a 5 cap, that if you do 100,000 on your calculator divided by 0.05 for a 5 cap, you'll come out with a building valuation of 2 million, right? So low cap rate, high property value. If we took that same 100,000 NOI and the broker said, hey, it's a little rough, we're expecting it to trade around a 10 cap, 100,000 divided by 0.1, 10 cap, right, would give us $1 million valuation. So there's obviously a lot of play in evaluation of a building depending on what the prevailing market cap is or is perceived to be.
Yep, that makes sense. Now, how do you kind of alluded to it, but I always look at cap rate and let me take a step back. If you're buying a house or a duplex or a triplex, for the most part, it's based on comps, right? When you go and look at the property, it's like, all right, well, that house up the street, this much square footage, this sort of amenities, yeah, it's going to be about this much. It's all based on what the market is from a comps perspective. The comps, if you will, in the multifamily space is the cap rate, right? The prevailing rate in an area is what you utilize. Would you say, or am I maybe explaining that improperly?
I think that is a great place to start. And that is, in theory, where we should all start. I don't believe it's the entire story, but you brought up a great point. Some folks that are listening might be coming from the single family space, and hey, that's where I came from. Jamie, you came from there too, right?
Yeah.
Right. So a lot of us get our start in the single family space. And the big difference once you move into commercial is that a property is valued based on how much income it can produce, not based on, the Jones's house 3 doors up sold for 250. So ours is a little nicer. It's going to sell for 255. It doesn't work like that. It's exactly a function of the income it can produce. So that's not the entire story. Things like deferred maintenance can cause a deduction from that value when you're submitting an offer. But it's a good place just for, what a mentor of mine, Michael Blanc, calls the 10-minute offer. Basically, you're just finding the NOI, prevailing cap, a reasonable expense ratio, and making sure all that checks out. And voila, in like 10 minutes, you'll have an offer. Then from there, you can go and put everything into a spreadsheet, analyze expenses, check out vacancy, loss to lease, all that stuff. market comps to see if there's areas in which you can improve, but that gives you a place to start.
Makes sense. So defined to you mentioned about talking to a broker about what a cap rate, what this property will trade at. Is that your best source to understand what cap rate you should be utilizing when analyzing property?
I would say, unless you're paying a bunch of money for like CoStar access, which is essentially the commercial MLS. So you can hop on CoStar and pull some reports, or if you have someone that has CoStar access, you can run reports for zip code, a city, to under a few different asset classes to kind of see where things are going, read the tea leaves, so to speak. And that's another thing a broker can be really helpful with is understanding where they're going. I think nationwide, specifically in multifamily, we've seen a lot of cap rate compression over the last decade since post 2008. We saw a little bit of an expansion, i.e., the investor field was perceiving more risk in buying any kind of real estate after the crash. Less so multifamily than single, but the cap rates expanded to basically show us that the appetite wasn't quite as hardy as it was, leading up to the crash. And then a couple years later, people realized that the sky was not in fact falling, and cap rates in most markets started to normalize and then actually trend down, and they've been on a downward trend nationally for the better part of a decade.
Let's,
So if something does happen economically,
yeah.
are cap rates going to expand slightly? I mean, maybe. So when you're analyzing an area, it's a good idea to kind of probe, your broker or look at the data and see, are the cap rates compressing along with everything else, or is something going on weird here where actually they're stagnant or expanding? I would want to understand why. The investor pool thinks there's more risk with whatever opportunity you're looking at, whatever market you're looking at there.
Okay. Let's dive into that just a minute here, because compression and expansion, those sound like big fancy terms. And I think just for the simplicity's sake, and you correct me if I'm wrong in saying this or I'm oversimplifying, cap rate expansion would be they're going up. There were 6, now they're 7, now they're 8, now they're 9. Fair? Compression would be they were 9, now they're 8, now they're 7, now they're 6. And as we talked about before, if a cap rate's going up, it means the price is coming down. There's an inverse relationship between the cap rate and price. Phil's right. Take your net operating income, divided by the cap rate, 0.10, if it's 10% or 0.05, and you'll see, just play around with that. You'll see how the number goes up the lower the cap rate you put in, the lower percent you divide by. So expansion is cap rates going up, meaning the property is becoming less valuable, if you will.
For the same income produced.
Correct. Right after the crash, you mentioned that there was like hesitation to get into the market, hesitation to buy hesitation with everything at that point. So, right after '08, if buyers are not making aggressive offers, if they're being very conservative in their underwriting, and that's what the market is doing, and everyone's doing that, it means that cap rates are going to go up. Values are going to come down a little bit. You talked about compression, and it's the opposite. So it's where values are going to go up because cap rates are coming down. And you feel like right now, and I agree with you, in a compression mode for years and years. So you mentioned a lot of factors, but at the core of it, if you see cap rates compressing in an area, that is buyer behavior driving that, correct? And if so, can you explain that a little bit more granularly?
That's my belief. And look, the secret's out, guys. Everyone knows we have a fantastic asset class here in multifamily real estate. Demographically, we know that a lot of folks are moving into multifamily homes in lieu of purchasing their own. And we could do a whole separate episode on why that is.
Yeah.
People are migrating away from North and blue in favor of South and red. I mean, Texas, Georgia, Florida, Carolinas on fire, right? And places like, I don't know, say Michigan. Sorry, Michigan multifamily more.
It's stable.
Pennsylvania, New York are net losers of population and have been for some time. So, you have to look at the larger stuff there. Another thing that's worth mentioning, but again, could be just a really wild tangent, is debt. Before we hopped on, Jamie, the Fed just cut another point.
Point.
So
Yeah.
great for us that have deals under contract and haven't locked in rates yet. Um, and it seems like debt's going to be good for the foreseeable. Forever? No, it just can't be. But for the foreseeable, there's great long-term debt out there available right now. So when you can leverage an asset like a multifamily apartment building, put 70, 75, 80% leverage on it at, 4%. I mean, that also leads to cap rate compression because, I mean, your money's working really, really hard when your down payment's 20, 25%, little capex, and 80% of it is essentially leveraged at the same amount of historic inflation,
Yeah.
So during the crash, I'm not going to quote exact because I don't have it in front of me and I don't want to tell you the wrong thing. But I was doing just some research on a couple of markets that I play in. And even post 2008 crash, the cap rate expansion, it wasn't a 6 cap to a 9 cap. It was like a 6 cap to like a 7.25 at the worst. And it quickly rebounded in about 18 months back to the worst of it, back to, a more historical norm. And something else that might be worth talking about here is, there's a little bit of subjectivity to a cap rate. We recently purchased a building and I would call it like a C minus, 12 plex. The thing just looked like the hills had eyes, that's just the vibe I got from it. Just scary building. But we just did everything: roof, new windows, hardy board siding, new decking, new lighting all around it, parking lot. I mean, the thing looks like a $1 million, and it's worth way more than that now.
Yeah.
And we renoed, the interior of the units, and we took the rents from, $700 to like 1,100, 1,150. So that on its face is fantastic. If that was a seven cap across the board, but I actually took, a couple brokers by to show them, hey, look what we did. You proud of us? Did we do good? And not only if we had our NOI increase as a direct relationship to those rents going up, that's all fine and good.
Mm-hmm.
But what I'm hearing from them is we've taken the building from a C minus more to like a B, like a solid B. So they're thinking instead of a 7 cap that we bought it at for C minus, deferred maintenance, ugly, scary, economy housing, to this is nice. Like, people want to live here. Like, people that make great money want to live here. They were saying that I could call this a 6.5 cap. So there's a little subjectivity to that. But that half a percentage point in cap rate that they're telling me we've earned by improving the property, it's a huge valuation difference.
You make a great point on A, B, C, D, just from a market standpoint, just to very quickly go over what that is. I think A and D are obvious, in my opinion. A, Manhattan, Boston, downtown Philly, high rise, every amenity, rents that you're like, oh my God, for a 1-bedroom, A class, right? Big dollars, high end, often newer property. A is easy. D is easy as well. Like, wouldn't go there even in the middle of the day, right? Like, just D class essentially. And then you've got this B to C range: B plus, B minus, B, C plus, C, C minus, and there's a space between them for sure. Especially you go B plus to C minus, but in the middle, it's you could argue, and I don't want to oversimplify, but you can almost like it. If I am oversimplifying, you can almost look at it like, all right, if a B plus is trading at a 5 cap, you could almost go up like a quarter point ish as you go. So B plus is 5, maybe B is 5.5, 5.25, and you get B minus, that's like 5.75, 6, and you go all the way down to C minus. Because like Phil said, the riskier the property, the higher the cap rate, right? The lower the value of that property. So when you're talking about cap rates in a market, it's not only like, okay, this market is a 6 cap. It's like, well, what's the building? Because the building could be classed as a C class property in an A class market, or vice versa, I guess. And that can impact where your cap rate would fall. So I wanted to make that point. And then you were talking about expansion and compression. There was something there I was going to ask you, but I can't remember what it is now. So, but I want to make sure I explain the ABCD. Go ahead.
So yes, that's great because I just talked right past that for anyone who hadn't heard those terms before. So, I maybe could have done an example to illustrate what I just said. But I did a
Yeah.
quick down at 30 with 100,000 NOI at a 6.5 cap versus 7 cap. And it's a difference in 100 some thousand dollars in value that we've created. And for appraisal purposes, you got to do a little bit of salesmanship. But that's why broker relationships are important. Knowing your market is important, because if you go in there and say that you're going to basically value a property at a 6.5 and you're wrong, it's a 7.5. I mean, it's massive. You miss the mark by a mile.
Yeah.
um, and the good news is, as cap rates contract or expand, like, it's not overnight. you know but another thing right now is you really don't want to be caught in any kind of like short-term debt, that if we did see some kind of a pullback, and you lost that whole point in like 6 months, 9 months, and weren't able to get it moved, that now all of a sudden you're underwater on a project.
So you're saying, real quick, you're saying that you went from a 5 cap to a 6 cap because of some huge change in the market. Is that what you mean?
If you did, and you were holding short-term debt, like in the
Yeah.
instance of a bridge loan, and you actually didn't create the value that you're supposed to create if you are doing a bridge loan. I'm not doing a bridge loan right now unless I'm adding at least 35% value, in my opinion, because then even if things do go a little wonky, like maybe we don't quite hit the mark on returns, which would be a terrible thing, but it's not like we're ever at risk of not making our debt cover, or losing the building. See, I
Yeah.
mean, that makes sense.
It does.
That's,
It absolutely
again,
does.
I'm probably treading into water that is a whole different
No,
call.
no, no. It's a good discussion, but the point is that well, and I do remember what I was going to ask you, and you're starting to allude to it, is in your underwriting, what you use, how you underwrite using the cap rate. So, to kind of demystify this a little bit, for the sake of those watching or listening, we talked about lower cap rate means higher value, right? So if you were to look at a property, and look, I think this is something you can look at, what the power of commercial property and cap rates and what they do for the valuation of a building. If you were to buy a 20-unit building and raise rents $20 a piece on that 20-unit building, that's, what is that, $400 a month
400 a month, yeah.
rent. That's $4,800, call it $5,000 a year. At a 10 cap, that's a $50,000 value add to your property by raising 20. So you imagine, go to a tenant saying raise $20. Most of them are going to be like, okay, $20. Seems like nothing. Like, I'm making an extra $20 a unit, whatever. It's $400 a month. But from a valuation standpoint, that increases your net operating income. And you take NOI divided by your cap rate, and you see the power of it. But to go back to this, you buy a property and you're looking at it as, okay, I'm buying this property at a 7 cap. And I know that when cap rates go down, the value goes up. So I want to improve this building, maybe jump it from a C- to a C or C+ type of property. So I get the benefit of better cap rates and a higher valuation. So when I sell it or refinance it or whatever, I get all that money. Yay, yay, me, right? That's kind of the idea. So you may be tempted to look at a town or a market and say, this place is only getting better. There's nothing foreseeable that can make this go anywhere but up. So I'm in at a 7, and I'm going to underwrite this when I trade it, when I get rid of it or refi it, at a 6 or 6.5. It's going to go up. What do you do, Phil, no matter the market?
So I'm going to take a slightly different tack because, so not entirely. I do the calculation that you just did. If I'm going to go do a big value add, because I'm trying to say, hey, what's the upside here? What can we really do? But I'm also going to take the other road, and instead of trading at a 7 that is market standard when we bought it, or we think we're going to improve it and get it close to 6.5 or whatever, I'm going to go the other way, and worst case it at an 8 cap exit, because I know we're going to manage it well. I know the building's going to be good, but maybe it's just something incredibly weird goes on with the market, and people are out of love with multifamily when we need to sell. So I can't I can't impose on you guys enough the importance of stress testing deals, particularly right now. You need to make sure that if, your occupancy goes down 10, 15, 20%, if your delinquency goes way up, if you're getting hit with some big bills, that you're able to not only survive but thrive in the investment that you've made in your time and money, but most likely a lot of other investors as well. So I'm going to look at the example that you looked at, Jamie, but I'm also going to look at the not so rosy side
Right.
and see if I'm okay with that result. And then kind of like assign some probabilities to each one occurring. And obviously the one that's not fun, I'm hoping that's a lower probability, but you have to look at it, with a sober point of view. There's a lot of money at stake. And, again, coming from single family, I took a bath on some single family homes, you know, I had some flips that went way awry. And I think that was a great thing because I lost 10,000 here, 30,000 there, you know,
Mm-hmm.
took some expensive lessons. It wasn't 300,000 in the case of a
Multifamily.
major miscalculation or letting your management or contracting get it off the rails in multifamily.
Yeah, I've heard it said, and it's so true. Do a conservative analysis of the property when you buy it, and then if it looks like a good deal, get more conservative. Try pressure testing this thing as far as it can go. Like, what's doomsday? And if you're still cash flowing, make an offer as quickly as you possibly can. But Phil, to get to like you mentioned, like maybe you're going to underwrite. Like I said, you may go in optimistically as somebody underwriting a deal and say, okay, I'm buying it at a 7. I can get this to a 6.5 because I know I can improve the property. So wow, look at what it could be. But then you're absolutely
Right.
right. You flip it around, you look at the conservative side. How do you go from say 7 to 8? Is it just kind of like a guess, or like do you use a certain amount per? Like what how do you get there? What's just
There's some really smart people that like using 15 basis points a year. So 100 basis points is 1 point in the cap rate, right? So that's 0.15%, right, a year that they would slide. If you're going out more than several years, I think that's probably a little too conservative. Looking at historic cap rate fluctuation, if you're going more than probably 150 basis points, I think that's like really, really conservative. Um, so I guess that's exactly what it would be on a 10-year hold at 15 basis
15
points per
basis points.
year.
Yeah.
Um, you know, so that's a rule that I've heard some people using. People that are using shorter term, like they really want to have that 5-year exit. I've heard of them using a quarter point. So again, we're arriving at a similar number, cap rate expansion to the tune of a point or point and a half. Um, they're just having it expand a lot quicker and them still having to exit year 4 or 5.
Yeah. So if you're looking at a 10-year hold, you might do 10 basis points. In other words,
10 or 15, yeah,
yeah,
yeah.
that's going to give you 1 to 1.5 higher percent cap rate, which is going to like show you that the value is going to go down. And then you can see based on, what the property is performing at that point, what it does, and do your investors get their money back. But if it's a 3-year hold or a 4-year hold, you might do a larger basis point per year
Mhm.
increase in cap rate in your
Yeah,
underwriting so
might do
that you can.
25, might do 25 or 30 if it's, a 3 to 5 year hold. Just, what I mean, and if it's an okay exit, when the market was at a 7 cap for this type of asset and we exited at 8.25 in 2023, if it still looks okay, then it's pretty strong. Um,
I love it.
so
No, this is great. So just recapping. See that?
mhm,
Recap rating. Cap rates drive value in the multifamily space.
mhm,
Asset class, which could be town and or property, are going to drive the prevailing cap rate in a specific market. Higher the cap rate, a higher the risk, therefore the lower the value of the property. So when you see a 15, 16 cap and somebody applauding it, look, 15, 16 cap, meaning you're going to get a 15, 16% return if you paid cash for this property. Look at that property because that property might be in an area of town that you don't want to invest in. Maybe it is. Some people can do really well in that. I know, Phil, you've had some properties like that. Um, the lower the cap rate, the higher the value. So you got to be mindful of that as well. And then when you're underwriting, make sure you're being conservative, meaning your cap rate should be going up. When you say I'm in at 7, see what it looks like going out at 8, a higher cap rate, not
yep,
6. You hit 7 or lower, then you're hitting the lottery. That's great. But at 8 you can make money. You're going into it conservatively and you're protecting your investment and more importantly, perhaps your investors' money. So a lot more to it than that. We talked about compression and expansion and how that looks. So if a buyer's market and they're pricing up the, people are bidding higher than what you think the value of the property is, cap rates are going to go down, and the opposite happens when folks kind of stay out of the market a little bit. So plus other factors. Lots there. Phil, how can people get in touch with you or find you? When can they find your book?
Can I hit one more thing, or are we just
Yeah,
too directly over?
you're good. You're good.
The
Go for it.
problem when we get together, man, is we can just go and go and
Go.
go.
Yes.
I think it's cool. It just letting me go off without a plan man, it could get
This is
weird.
the plan. No, I hit it.
All right, cool. So I don't want everyone to know this because deals are already hard enough to come by, but your folks, these are good people. We want them to have the information.
I like it.
I love it so much when someone comes to me and tells a war story on why they couldn't buy a building because it was at a whatever cap. It was a 5 cap and the market is 7. So they couldn't buy the building. Okay, well, I'm going to go buy the building at the 5 cap because what you fail to realize is there's a 20% economic vacancy because the seller is self-managing it. And as soon as you get it up to market standard at 92 or whatever, it's actually now at 8.5 cap at your purchase price. Once you just spend a few months fixing what they're doing terribly. Or if you can go and turn units and accomplish the same kind of thing. Cap rate is not the end all be all, guys. It's important when we're getting things appraised. It's important when we're, getting new debt on buildings or when we're cash out refining and trying to recapture that capital. It's important when we're negotiating. But, it's, I don't really know how to explain it other than, when don't let it be the reason that you kill a deal. Okay.
Just the cap rate. Yeah.
You have to be a detective in this business. And, like that one ugly building you're talking about, Jamie, their water bill historically was 50 grand a year for that complex 64 unit. And it shot up to 75,000 the year that we were purchasing it. So everyone else was running their numbers, going through the expenses, 75,000 for water, blah, 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 blah. And based on the purchase price or the list price, it wasn't working, right? But what we found out on that building during our due diligence is that the water meter on the city side had actually broken and it was just spinning. So that, let's just use real round numbers, that 25,000 extra in expenses per year at a 10 cap, and trust me, the market's lower than that. It's $250,000 in value. This was a couple $1 million building. So some other folks that looked at this deal were off by more than 10% on what the true valuation on it was because they missed that. So they took the expenses, gross minus expense, NOI, did a quick calculation like we did here, and they stopped. They didn't keep digging. So don't spend so much time on figuring out the minutia of a cap rate that you miss what's actually important about the deal. So
sage advice. No, that's a good point. It's a great point. Yeah, you mentioned the Michael Blanc 10-minute thing. It's a great place to start, but then you start diving in. You're right, though. Cap rate is a key component, but it's not the only component of analyzing a deal. So, no, it's good stuff, man. That's good stuff. But now tell me how people can get in touch with you if they want to.
Facebook, I don't know. Send me a message. Be persistent about it because there's too many trolls on Facebook. But if you actually want to talk about multifamily or, I'm always down to talk when I have time, usually when I'm on the road from building to building, hopping on the road tomorrow to drive out of state to look at 100 unit. And it's pretty much the exact example I listed. They're like, hey, we needed to trade at a 5 cap, but it's 80%, economic occupancy. There's a lot of deadbeats in there. Yeah. So we fixed that, and all of a sudden we made, $1 million. Yeah. So is anyone else going to figure that out? Can we negotiate with the seller? I don't know. Sorry. So yeah, I like to chat when I'm out looking at buildings. So that's often. Hit me up on Facebook. We can make that happen. Okay. PhilCapron.com, PhilCapron.com.
Love it.
It very basic landing page. So you can shoot me something to do there. Look for my book, Your VA Loan and How It Can Make You a Millionaire, launching Veterans Day, November 11th.
Love it. Love it.
Definitely.
That's right. It's going to be amazing. It's going to be amazing. I know this book is going to be great. So Phil, thank you so much. I appreciate you doing your dance on cap rates.
No worries. Good
All right,
talking
brother.
to you. Later.
We'll see you.